Today's the day. NVIDIA after the bell. 30 minutes until the opening bell. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, we have a parade of retail results kicking off the morning, but it's all eyes on NVIDIA today after the bell. Meanwhile, in Washington, President Trump explicitly guarantees Fannie and Freddie, while a new twist develops in the Japanese takeover of U.S. Steel. Plus, Antonio Filosa takes the wheel at Stellantis, while Nissan goes hat in hand to stay on track.
All right, shall we go back to NVIDIA?
Yes, please.
I think we should. It's finally here. NVIDIA, the final Magnificent Seven stock to report earnings today, with shares up 40% since its April low, just about flat for the whole of 2025. Results clearly likely to move markets. Right now, pretty well behaved, up just 0.7% after a big day yesterday.
One of the last companies to report earnings season is almost over. This morning we got, though, plenty of retail results. Macy's topped sales expectations and maintained its outlook for the year. Dick's Sporting Goods also kept its outlook, while Abercrombie and Fitch raised its guidance.
All right, so earnings season, it's not quite over, so let's get back to NVIDIA. Shares expected to move more than 6% in either direction following its report. Earlier today, D.A. Davidson's Gil Luria says that chip export controls are the main focus.
We really don't know what the level of restrictions are on NVIDIA selling chips into China, which chips they can sell, when can they start selling them. We know that there's legislation coming to further restrict them, regulation coming to further restrict them. So we really want to hear from them, what chips can they sell into China and when can they start selling them.
And for more on NVIDIA, we are joined by Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh. So Mandeep, we are used to an NVIDIA that meets and beats unbelievable results and then forecasts something that nobody can buy. Is that era over?
Not really, but I think right now the focus has shifted from hyperscalers to sovereign AI. And up until now, everyone was like, if hyperscalers are raising their capex, most likely NVIDIA will have a beat and raise quarter. This time around, you are fixated on China and sovereign AI demand, UAE, Middle East, how that's going to translate into demand for NVIDIA's chips, because sovereign AI is becoming a very sizable portion of NVIDIA's business. And look, I mean, somebody has to step in terms of sustaining that, 30-35% growth rate that NVIDIA needs to sustain its valuation multiple. And I think hyperscaler capex seems to be decelerating. I mean, they're still going to have a good year from hyperscalers in 2025. 2026, probably you will see a slowdown to 10 to 15%. So that's where the sovereign AI piece is very important.
I want to talk a little bit about production here, because you think about its new Blackwell chips. It really ran into some manufacturing issues in the fourth quarter. We know that there's heavy demand, but are they able to actually make the chips and get them out the door?
I mean, that's where the pricing power and the gross margin comes into play. If their customers are still willing to pay, the premium pricing that NVIDIA has had because the market has been undersupplied, that's a sign that, their customers are implementing these big NVIDIA systems and they are willing to pay up the price. If that comes down, and the reason why I say if is because the market has pivoted from training to inferencing. So far, it was about using the chips for training the next version of the large language models. Now it's about deploying them for ChatGPT use case. I mean, ChatGPT has 600 million weekly active users. All that is using GPU capacity, but it doesn't need the same kind of chips that were used for training. So that's where the pricing element comes in. Can an AMD or an Intel step in now that the market is moving more towards inferencing?
All right, Mandeep, great to get your perspective as we count down to NVIDIA earnings. You have fun after the bell. That is Mandeep Singh of Bloomberg Intelligence. And tonight, don't miss our Bloomberg Technology special featuring an interview with NVIDIA CEO Jensen Huang. That's at 6:30 p.m. New York time. And of course, it's not just NVIDIA reporting earnings today. We also had retailers Macy's, Dick's, and Abercrombie & Fitch all reporting results before the bell this morning. Let's get a read on retail now with Sucharita Kodali. She is a research analyst over at Forrester Research. Great to have you with us. I want to start with Macy's, up about 4% pre-market. So it actually beat when it came to its quarterly results. This stuck out to me. It maintained its sales outlook. That's hard for any retailer to do right now, Sucharita.
Right. But at the end of the day, Macy's has been a bit challenged. And I think that the expectations have been relatively low. So that's really what we're up against. The department store sector, particularly in the mid-market sector of the retail world, has been challenged for decades now. And Macy's is by no Macy's certainly is no exception. I mean, when you look back 20 years, it had nearly 3 times as many stores. So it really is on a lower base, and they're basically essentially resetting expectations for how the business could do now.
You know, Sucharita, Romain Bostic had an interview with the CEO this morning, and he told him they're not really pulling forward their inventory build in fear of tariffs to come. Is that the right move?
Well, there is just still a lot that is uncertain about what will ultimately shake out with respect to tariffs. I think there's still very much a working hypothesis that this is all political theater, and the outcome for most retailers will probably be more modest than what some of these expectations are. I think a lot of the actions that have been taken to date are largely driven by uncertainty. So I think that what we're seeing is just the response to just not knowing more, because the risk is that if you pull forward inventory, you may just be left with things that are not on trend, and you end up discounting it later anyway. So I think that they're probably looking at other geographies where they can pull inventory from, and looking to potentially diversifying if they need to, otherwise maintaining where they need to be otherwise.
Let's talk about pricing, too, because also in that interview with Romain Bostic, the CEO said that there are opportunities to be able to be sharp and to be able to continue the same pricing strategy we have today. And there are other places where there's going to be modest price increases. You take a look at what actually drove results in the latest report. It was Bloomingdale's, it was Bluemercury. These are higher end parts of the business. And I don't know, if you think about prices actually on the rise, or is it those areas where consumers are actually able to withstand some more price increases?
Well, there are different products that are going to have different elasticity levels. So certainly there are going to be things like essentials or things that are often replenishment goods, like, for instance, in cosmetics and beauty, where there may be an ability to price higher for sure. And then there are going to be other categories that typically tend to be in apparel, perhaps in some brands within footwear, where there may not be that ability to increase price. And I think that that's what we're going to see Macy's being laser focused on. Their merchants are really, really going to be looking at data from the past on when they had promotions, which were the categories, the sectors, the brands that they had the ability to increase their prices on, and which were the ones that were most sensitive based on pricing. So I think that that's really what we're going to see, not just at Macy's, but at virtually every retailer, whether it is Walmart or whether it is high-end luxury retailers like Gucci, that will likely do that same analysis across their entire portfolio of brands and products.
Sucharita, great to have some time with you. Hope we get you back soon. Sucharita Kodali there of Forrester Research talking to us about Macy's. Now let's get to automotive. The big executive shakeup overnight. Jeep maker Stellantis has appointed its head of Americas, Antonio Filosa, as CEO in an effort to turn the company around. His predecessor, Carlos Tavares, was forced out over slumping sales and profit. Bloomberg Auto's reporter Gabriella Coppola joins us now to explain Filosa's priorities. Gabby, what do we know about he's not a new face on the scene, but definitely to the top seat in the C-suite.
Yeah, Habemos CEO. I've been waiting for 6 months for us to finally have a CEO of Stellantis. And so I think there's a lot of relief and excitement today just that the company can move forward now by making a choice. In terms of his priorities, I mean, in the U.S., they've got to get their market share back. You know, a lot of share was lost under Tavares, especially for the key money-making Jeep and Ram brands. And they are working on that, but it's obviously been complicated by the trade war and tariffs. They have some vehicles that are made in Mexico and Canada that have some sort of the whole pricing model of how you make money off those cars has been in flux because of the tariffs. And then to look more globally, you know, Stellantis has 14 brands, and I don't think there are the sales that really justify keeping all of those brands and the jobs they support. And so one thing that Filosa is going to have to tackle is to take a really hard look at all of those brands, you know, across France, across Italy. And I think one of the things that made this job, you know, difficult to fill is that you're not just running a car company, you're sort of like, you know, acting as Geneva, or it's like running the EU or something, because you've got, you know, France owns this, you know, a significant stake in this company. So does Italy. John Elkann, the chairman, you know, the scion of the Agnelli family. Each one of those countries wants to see this company protect their auto jobs and manufacturing sector. And of course, Trump also wants to see more jobs in the U.S.
Right. Well,
so, yeah, go ahead.
Gabby, to that point, the fact that, you know, he's taking over as CEO, taking the top job at this time, there has to be a pretty hefty political element to what he has to do in the months ahead. How much time do you anticipate that he could be spending in D.C., for example?
I think that's definitely going to be part of his portfolio, but I would also point out that John Elkann, the chairman, has spent a lot of time in D.C., you know, and Paris, you know, in Turin, speaking to Giorgia Meloni in Italy, Macron in France. I mean, I think Elkann, you know, in the past, you know, he's always been involved, but you had Sergio Marchionne, who was a very hands-on CEO. You know, Tavares was very hands-on. I think Filosa will be good in that sense. He's a very personable, warm, friendly guy. He's well-liked, I think. You know, he was kind of started out as like a plant rat, as we say in the auto industry. He worked in plants in Italy and then Argentina, Brazil. So I think he could be very good in that way, too. But John Elkann is a guy who has an amazing global network of business people, politicians, contacts, and he has worked very hard to build back a relationship with President Trump. So I don't know. I think it remains to be seen, but I can't imagine that they wouldn't continue to use him and his diplomatic skills to kind of help support Filosa with all the things on his plate.
Absolutely. It's going to be fascinating to see how this develops in the months ahead. That is Bloomberg's Gabrielle Coppola reporting from Detroit. Now, coming up, President Trump says that the U.S. government will keep its implicit guarantees on Fannie Mae and Freddie Mac, even when they become public firms, which the president says he's working on. We'll bring you the details next. This is Open Interest.
Let's get now to high interest and look at what's making headlines around the world. Honeywell agreed to give Elliott Investment Management a seat at the boardroom table as it prepares to split into three. Elliott revealed a $5 billion stake last year and called for a breakup, blaming Honeywell's conglomerate structure for poor financial results and share performance. Elon Musk says he's not happy with President Trump's tax bill. He says it undercuts his efforts to slash government spending. He spoke in an interview with CBS.
I was disappointed to see the massive spending bill, frankly, which increases the budget deficit, not just decrease it, and undermines the work that the Doge team is doing.
The legislation now advances to the Senate after it narrowly passed the House last week. Meanwhile, his Starship rocket tumbled out of control and disintegrated as it hurtled back to Earth yesterday. The stakes for SpaceX were high after the two previous flights exploded over the Gulf of Mexico, sending debris raining down from the sky and disrupting air travel. Katie?
All right, let's turn now to shares in Fannie Mae and Freddie Mac rising in the pre-market trade after a big week last week. Now, that's all after President Trump said that the U.S. government would retain guarantees on Fannie Mae and Freddie Mac when they become public firms, which he's working towards. President Trump posted on Truth Social yesterday saying that he's working on taking these, quote, amazing companies public. For more, let's break it down with Bloomberg White House reporter Josh Wingrove, who joins us now from D.C. And I want to talk about this part of his post, that the U.S. government will keep its implicit guarantees and I will stay strong in my position on overseeing them as president. Josh, what might this all look like in practice? Because there's a lot of question marks here.
Well, that word implicit, my gosh, is carrying a lot of water.
Thank you.
Honey, can you swap the laundry out today? Yeah, you have my implicit guarantee that I will absolutely do that. So the short answer is we don't know. This has been simmering in the background. In some ways, it is not a surprise, right? Biden, on the way out, some of his staff tried to set like a game plan for how bringing these companies public would look. In other words, they kind of tried to tie Trump's hands a little bit. And since then, it's been sort of like laying in the reeds as Bill Pulte, the head of the FHFA, has sort of hinted here and there before Trump in the last week or two has really ramped up the signals. Now, so the interest is there, but the details just remain so unclear, including what those implicit guarantees or whatever we're going to call them would be. Because, of course, if it's not a full guarantee, it's not much of a guarantee at all. And hanging in the balance of that, of course, is the question about mortgage costs. Pardon me?
He was pretty explicit about it. I wonder if he was laughing to himself as he explicitly wrote about the implicit guarantees.
That's right. That's right. Yeah, he's dancing on both sides of that fence right now. But we're going to see. We're going to see where it goes. I think there's a clear appetite in the administration to at least pursue this. As always with Trump, he tends not to get bogged down early in the questions of, what he would consider fine print, like the guarantees. But I think that there will be corners of the Republican Party, if not the administration, that start to get nervous if bringing these companies public really does start to reflect in mortgage rates and, overall costs, which of course Trump is politically sensitive to. So I think that's the third rail here, but clearly there's interest in it. Bill Ackman and other Trump supporters have stakes here as well that are sort of looming large, and so I think the direction is clear. The path is not clear, nor is it clear whether they'll reach that destination entirely.
Josh, how does President Trump sell a Japanese takeover of U.S. steel to the American people after he and Howard Lutnick have gone on for so long about how important it is to keep these industries for national security domestically owned?
Yeah, this is certainly a reversal from his rhetoric on the campaign. There's two things I think that they'll point to. Number one, we've already seen him pointing to a $14 billion investment. Nippon Steel has not detailed that, but that's up from about 2.7, and not to be confused with the $14 billion acquisition price. So more money being pledged here. Whether that materializes or is guaranteed is really unclear right now. And the companies, as I say, have not sort of broken down the cost of where they plan to put that money. The other one is that he's talking about control, and what that looks like is also unclear. But there will be some measure of U.S. nationals on the board of the American subsidiary, U.S. Steel, owned by Japan's Nippon Steel. There would be an American CEO, it looks like, as well as other sort of quasi-veto powers that seem to be coming through on this. Now, they're still working on the fine print. We are barreling towards a Friday rally in Pittsburgh. We just don't know what that'll look like, but Trump is trying to basically lock it up somehow in a way that he can claim some measure of control, even though this company will be owned by the Japanese company.
All right, Josh, thanks so much for joining us. Bloomberg senior White House reporter Josh Wingrove in Washington. Coming up, Truist Keith Lerner argues the market's risk-reward ratio is less favorable following a string of positive trade developments. We'll discuss with him next. This is Open Interest.
Welcome back to Open Interest. Barclays out with some good news for the bulls, saying that the path of least resistance for stocks is higher. Strategists saying that earnings showed resilience in a positive sign for equities, and with institutional positioning underweight, systemic dip buying means that stocks will likely trend higher from here. Let's break it all down with Truist co-CIO and chief market strategist Keith Lerner. Keith, it's great to have you back with us, and I'm curious what your base case is from here. You have Barclays talking about earnings season going pretty well, about positioning right now, really leading to maybe some dip buying here, but we still have one big one after the bell, and that's NVIDIA.
Yeah, well, great to be with you. And you said it. I mean, the catalyst, what we're all waiting for today, and really probably for the next few weeks, is what happens today. I think everyone's expecting a strong print from NVIDIA. They've beaten 9 times in a row, both on sales and earnings. So the key question is, how does it act? What's interesting is the stock since last June when it peaked is basically flat, 0.06%. So that'll be the key driver. I think we're in a choppier, broader range in the near term is really what we're thinking here near term, though.
Does NVIDIA, Keith, in 23 and 24, they didn't just beat, like they knocked the cover off the ball and unwound the threads inside. So do they just have to meet the street's lowered expectations here, or do they have to really do something extraordinary today?
Yeah, I think expectations have come up as the stock has rebounded. Remember, it was below 100 not too long ago, so I think the expectations are somewhat higher. I do expect them to be. I guess the question is, do they break out of this range? If they break out of their trading range for the overall market, then the pain trade is higher for the overall market because tech is such an important component, and it's been in the trading range. So I think this is really going to be key, not only for today, but for the next few weeks.
All right, Keith, great to get some time with you. We are just getting started. You're sticking with us through the opening bell. That is Keith Lerner. Let's take a look at the setup as we're just minutes away from the ringing of those bells. You can see the S&P 500, it's pretty much flat, a little bit higher if you take a look at big tech and the NASDAQ 100, the Russell 2000 unchanged. But we know that yesterday was a big day in the market, a big rebound.
We were up 2% on the S&P.
I know, breaking several days of losses. And right now, if we thought we were in a wait-and-see mode yesterday, truly at this point on Wednesday morning, we are in wait-and-see for NVIDIA.
I will tell you that we're getting a red headline crossing the terminal right now. Germany has agreed on an additional 5 billion euros in fresh military aid to Ukraine. I know that Volodymyr Zelensky had been calling for at least another $30 billion, so this gets him more than a sixth of the way towards that. But once again, Germany has agreed on a fresh $5 billion in military aid to Ukraine, and we'll see if other countries follow suit.
Yeah, we'll keep an eye on that, but we'll bring you the market open up next. Don't go anywhere. This is Open Interest.
We are moments away from the start of trading on this Wednesday, second trading day of the week because we had Monday off for Memorial Day, but Tuesday was a banger, up 2% plus on the S&P 500, and today we're going in little changed as we wait, I guess, until after the bell for NVIDIA earnings. That's really going to be the big one. I think Dan Ives said it's the most important company in the world for markets. There you see the opening bell. On the NASDAQ, you've got Qualcomm ringing the opening bell, celebrating, I think, 40 years of doing business as a company, and the stock has more than doubled in the last 5 years. It's down 30% over the last 12 months, so they can do better. You've got LTC, a REIT, ringing the bell on the NASDAQ. No one cares about that, right? But we do care about NVIDIA. Katie Greifeld is here with a look at the shares in the live trade.
Here is the setup, of course, right now. You can see NVIDIA almost perfectly flat right now, up a little bit. It did have a big day yesterday. It's the final big tech stock to report earnings. Shares are up about 40% since its lows in April. I do think it's poetic that for the whole of 2025, this stock is almost perfectly flat, Matt, for the year. So this will be a fun line to watch later today.
Yeah, just like the market today, right? Even though we've had multiple retail earnings out this morning, Macy's beat estimates, beat sales expectations at least, maintained its outlook for the year. Romaine Bostick had an interview with the CEO, which you're going to hear more from throughout the day. Dick's Sporting Goods also kept its outlook stable, and this is fairly unusual for retailers or a lot of companies this earnings season. Abercrombie and Fitch, this is a company I forget still exists. It's like reborn from the 90s, up like 600% over the last 5 years. Raised its guidance and now sees a record intraday gain. You can see the stock up 32% in the cash trade. We're back with Truist co-CIO and chief market strategist Keith Lerner. And Keith, more and more when I read not only the economic data, the hard data, but company results, I'm starting to think maybe it's not going to be as bad as we thought. Maybe tariffs aren't going to be the end of the world. Maybe we're not going to see massive inflation and every company pull its outlook. How's it looking to you?
Yeah, I think you hit it on the head there, Matt. I mean, one thing that really stood out during this earnings season, during all of this, craziness that we went through, is the resiliency of corporate America. And we have to remember, these companies have been battle tested. They've been battle tested through COVID. They've been battle tested through one of the fastest rate hike cycles we've seen in the last 30 or 40 years, and one of the highest inflation environments. So they have a lot of different levers, and they're resilient. And then the consumer has also been relatively resilient as well. So what we're seeing right now, which is notable, is the forward earning estimates for the overall market had started to trend down back in March and April. That has now stabilized, and we're starting to move, somewhat up. So I guess the message is, don't underestimate the resiliency of corporate America. They're doing it, they're doing it again.
Yeah, it is fascinating, Matt, to your point, that we didn't see that much in terms of guidance being pulled. We saw some of it. We saw some of the airlines, for example, come out with a few different scenarios about how things would go. But like you say, Keith, corporate America is battle tested at this point. I want to talk about how Fed policy plays into all of this, because we keep hearing from Fed members and from Jerome Powell is that they're waiting for clarity, that it's really hard to make policy when we simply just don't know what's going to happen with trade policy. And I wonder, when you marry together the resiliency of corporate America, of the consumer, with the uncertainty over Fed policy, where does that leave you?
No, it's a fair point. And what happens on these Fed cuts, it seems like they just keep getting pushed out. Like we were expecting in June, and now the market's expecting maybe in September. So we still think likely later this year they at least cut 1 to 2 times, because I think the inflation backdrop, outside of the one hiccup on tariffs, which is a big hiccup, like some of the trends as far as oil prices, housing prices are coming down. But there is a lot of uncertainty. But I will say overall, I don't think they're the main mover for this market, whether they cut rates or not. What you can do is you overlay the trade uncertainty index versus the S&P, and they're moving in lockstep. So I think the more important part for the market right now is this de-escalation that we've seen. Does that continue? Don't forget we have a July date coming through, and I think that will be a bigger force for the overall market than whether the Fed cuts rates 1 or 2 times, or if they just kind of sit idle. And in a holding pattern.
Keith, I'm going through, you have 3 bullet points in your notes to us that make total sense to me. Large caps over small caps, totally get it. Comm services and utilities, obviously. At the lows, there wasn't as much, there was more reward, I should say, than there is at the highs now. Okay, I get it. But industrials and financials, why do you like those 2 groups?
Yeah, well, in big picture, what you just said, Matt, is, at the lows, the market was pricing in a recession. We basically priced out a recession. So a lot of good news is priced in for the market as long as the good news comes through. But the risk reward is, more mixed in our view, big picture. And then to your question specifically.
That makes sense as the price rises, right, Keith? I mean, I'd rather buy low than high, too. Yeah.
Exactly. That's what we all hope to do, right? Well, with financials, I mean, they've hung in there really well. And talk about the economic resiliency, we're actually starting to see bank credit growth start to move up again. And if we get a little bit of a steeper curve, that's a positive. And that one carrot that we're all waiting for is to see a little bit more deregulation as well. And the technical trends have been positive. So we look at the fundamentals and the technicals; they're both aligned right now. And then on the industrial side, I mean, it's the strongest sector year to date, which is, if you were to come into the year and say we had all this tariff uncertainty, you wouldn't expect industrials to be one of the best sectors. But they're benefiting from a couple of secular trends. One is defense spending, right? Especially the global defense spending. Number one, a lot of that global defense spending is coming back to the U.S. And then it's also kind of a backdoor play on the AI story. You think about some of these old industrial companies, cooling systems as an example. That's a big part of the AI story as well. So I think it's benefiting from both. And so we have some defensive, we have some cyclical exposure. It's kind of not, in our view, it's not an all or nothing market. You want to have exposure to the best cyclical areas. Defensive is more utilities. Utilities are also more of a, it's a defensive play, but also an AI play as well. So it's kind of, everything's getting a bit more blurred in today's market with this AI trend.
All right, Keith, got to leave it there. Always great to talk to you. Thanks for opening these markets with us. That is Truist's Keith Lerner. Now, Keith said holding pattern, and that's exactly what you're going to see if you take a look at the breakdown of this market right now. The S&P 500, it's pretty much flat in the first few minutes of trading. And take a look at the split. You have 223 names moving to the upside, 274 to the downside right now. And you take a look at the moves in terms of the points contribution, what the actual percentage gain looks like. It's very small. Apple is up just a little bit. That enough in this market right now to make it the biggest contributor on a points basis. Meta, Amazon, Alphabet also rallying a little bit. You have NVIDIA shares down slightly right now. And let me emphasize slightly. Of course, all the action is going to come after the bell today. So almost an even split when you take a look at the stocks themselves. You're going to see a similar thing if you take a look at the sector look as well. Right now, if we switch up the board, you can see that we have more in the green when it comes to the sectors themselves. Some of them in the red. Materials, real estate leading the way lower. Communication services and tech trying to move to the upside. But Matt, let me stress again, small moves overall.
Yeah, small moves overall, and I guess we'll see if that changes throughout the day, Katie, right? Because we're waiting for NVIDIA, and that doesn't come out until the close of trading.
That's true, yeah. It's, again, a holding pattern, I would say. But, you know, news likes a sleepy market, so we'll see.
All right, we're going to continue the conversation on NVIDIA with Pierre Ferragu of New Street Research. He joins us next. This is Open Interest.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Fair Isaac is getting raised to a buy over at Baird thanks to regulatory easing. The analyst says that FICO scores have an attractive market position. Next up, we have Booz Allen getting cut to a sell over at Goldman thanks to limited growth potential. The government consulting firm announced last week that it would slash its headcounts in response to the Trump administration's move to shrink government spending. Shares down about 1%. And finally, this is a fun one. Freshpet getting downgraded over at TD Cowen. The analyst cites slowing retail sales and a risk that its refrigerated dog food concept is nearing a saturation point. Matt Miller, perhaps they're going to expand to refrigerated cat food.
Don't cats just eat whatever you put in the bowl?
No, you have to feed cats.
Oh, they're finicky. They're finicky
They're
felines.
very finicky, but you have to make sure they get wet food because it's really important for their kidneys, in case you were wondering.
Okay, good to know.
Yeah.
I have a couple of cats, but I wish they didn't exist.
Maybe don't get them more wet food
Let's
then.
get back to the big stock story of the day. NVIDIA will report earnings in a test for the AI trade and potentially the general direction of markets. For more, we're joined by Pierre Ferragu, Global Team Head of Technology Infrastructure at New Street Research. And Pierre, I just wonder, and I've been asking all morning, doesn't this company really have to kill it? I mean, if they just do okay, isn't that not good enough?
Or if they do okay, it's not going to be good enough. It's going to be fantastic. You know that NVIDIA is today, facing these additional restrictions, export restriction in China. So we should expect the guide for the second quarter to be actually quite difficult. You have about 1 quarter of sequential growth that is going to go away because NVIDIA cannot sell the H20 chip in China anymore. So it's going to weigh a lot on numbers. If you look at expectations today, they're probably like 2-3 billion too high for the next quarter. So the guide is going to be below expectation. It's almost certain. The good thing is that if I'm telling you that on such a relaxed tone today, it's because most investors understand that and follow that name quite closely, understand that you have like an export restriction. And of course, it's a one-off because what is NVIDIA going to do is develop a new chip, the B40, that will fit the specification of export restriction, and they will be able to sell it in China starting in June or July, and things will get back to normal.
Well, let's talk a little bit more about China because CEO Jensen Huang, he said that when being critical of U.S. policies, that he's basically going to have to cede a market that could be worth $50 billion in 2026 to Chinese rivals. So clearly, of course, Jensen Huang is frustrated here. Do you think that the situation is quite as dire as he paints, though?
Well, he's being quite factual about it. He makes about like $20-25 billion of revenues in China at the moment on a run rate basis. That's about half the opportunity. If NVIDIA had in China the market share they have elsewhere in the world, they would probably be making closer to 40 billions. So that's a reality. And then, of course, he plays his role and he's trying to have the influence he can. The US administration has to walk on a thin line between, defending the interest of US companies and achieving their goals of, limiting technology exports to China. It's a back and forth. It's already like the third or fourth time we have such a back and forth. The game is about the administration tightening restriction and NVIDIA creating a chip that just goes under the restrictions so that they can continue to do some business in China.
Do they walk the line when it comes to regulations all the time, Pierre? I mean, I'm always reading stories about how NVIDIA sells chips to some market in Singapore, which then those chips kind of make their way to China anyway. Doesn't the company know that this is happening, and aren't they somehow responsible for that?
No, I think it would be a very unfair claim to say that. On the contrary, NVIDIA has always been very, very proactive and collaborative with the administration on export situations. So they voice, their perspective and their view, and at the same time, they are like really 100% compliant. It is true that there can be some, suspicion that some of the chips end up in hands that were not the originally intended hands. But remember, we are talking about a business that went from being like a single-digit $1 billion business annually to a $200 billion business this year. And it's very, very difficult to keep track of everything. But on large volumes, I would say NVIDIA is very, very tight and controlling as much as they can, where their chips end, of course. But they can't control 100% of $200 billion.
Right. And I want to talk a little bit about how the stock itself is trading. We've been making the point throughout this hour that it's pretty much flat when it comes to 2025 as a whole. It's up 40% from its April low, but it's still down from its January high. If you take a look at its valuation, it's priced right now at 29 times its projected profits over the next 12 months. Its historical 5-year average is about 40. Can we actually call NVIDIA stock cheap here, Pierre?
Well, it's always difficult, to call a stock cheap, but relative to history, you just gave the number. So yes, it is like trading at a 25% discount. So the situation today on NVIDIA stock is twofold. So there is first this uncertainty around China that makes people a bit nervous on the print tonight, of course, but it's actually a small moving factor in the stock. What really matters on NVIDIA is that the business has grown so fast and reached levels like hundreds of billions of dollars spent on GPUs that investors are putting their head around it and getting some comfort that the numbers are going to be made and actually even better in 2025. And then suddenly the concern shifts to 2026. And then investors are worried about this growth having gone too fast, too rapidly, and then they're worried about a pullback, about a slowdown, etc. And that's what's weighing on the multiples. That's very, very usual. Now, our own perspective is that 2026 is actually shaping up now very, very well for NVIDIA. The way we look at it is going back up the supply chain. So we look at the suppliers of NVIDIA, TSMC, who supplies the CoWoS packaging capacity, and then we look at suppliers to the CoWoS manufacturing chains. And these players are already telling us that the outlook for 2026 looks very strong. So we should see the stock work well because numbers are going to work well, but the multiple, the 29x KD you just mentioned, might continue to come down just because investors, the more NVIDIA is growing, the more investors are going to be concerned about when the slowdown comes, basically. So that's like a natural derating situation for a growth stock.
Pierre, always great to have your expertise. Really appreciate you setting me straight on a regular basis. Pierre Ferragu there of New Street Research. By the way, tonight, don't miss our Bloomberg Technology special featuring an interview with the CEO himself, the godfather of AI, Jensen Huang. That's at 6:30 p.m. New York time. This is Bloomberg. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. The S&P right now very unchanged, and the NASDAQ 100 almost the same. So green arrows here, but not a lot of movement as the whole market, the whole world, in fact, waits for NVIDIA to come out with earnings, which doesn't happen until after the closing bell, but maybe today we'll just sit on our hands. Normally I have behind me all of the biggest stocks moving the indexes today, but what I have now is a list of the 10 stocks that BI, Bloomberg Intelligence, recommends you take a look at right now. And with that, I'm going to hand it over to Katie Greifeld and Gina Martin-Adams.
Yeah, let's talk about this all with Chief Equity Strategist over at Bloomberg Intelligence, Gina Martin-Adams, sitting to my left. So this list that you put together, it's the 10 S&P 500 companies that face the greatest risk from Donald Trump's tariffs that could come on July 9th, bearing another delay here. What stands out to me is that, you have names such as Philip Morris, you have Kimberly-Clark, Merck, Cisco, Coca-Cola. It's really covering a lot of different industries here. There's not a huge Venn diagram. So what led you to these companies in particular?
Well, they have the most factories and the most factory exposure as an overall share of their factory base. So this is specifically about companies in the S&P 500s that have factories overseas. And so we screened for overall factories. Roughly half of factories owned by S&P 500 companies are actually outside of the United States, first of all, which was kind of a stunning statistic to think how multinational. Half of factories operated by S&P 500 companies are outside of the United States.
Wow.
So that says a lot about just how much an upending of the global trade order could really impact operations of these companies. Now, of course, some of these operations are in foreign locations to service those foreign markets. I think the market is right now saying, well, those won't be impacted because this is really all about tariffs and the import prices of tariffs going higher. And obviously, that's the most profound near-term risk. But longer term, you can make a case for those factories also being somewhat vulnerable. Potential retaliations by those countries, for example, could impact operations of S&P 500 companies that are trying to do business in foreign markets to service the foreign consumer. So we're trying to take a very long-term view. This president has made it very clear that he wants to change the dynamics of global trade. That means that even after 90 days, we can't rest on our laurels and anticipate that it's all over. We're just going to sit at 10% forever. I do think that he's going to continually come back to this well over the course of the next 4 years to change prospects. So that's why we created the list.
So which of these companies do you think is most at risk or most needs to bring production back to the U.S.? And are any of them actively doing that now?
Yeah, I think that many of them actually started in the first Trump administration to try to address supply chain risks, but not necessarily in the form of bringing the companies, the facilities back to the United States.
They moved it from China to Indonesia, China to Vietnam,
building
China to
them,
India.
You know, the biggest headline example in the S&P 500 is, of course, Apple, which isn't on our list, interestingly. But nonetheless, Apple gets the most attention as a target for President Trump right now because they did move their operations or move a great deal of their facilities from China to India to
Why
try to account for.
Why is it not on your list? So widely held?
Yeah, because it's not actually of the most exposed. It is widely held, but it doesn't have as many factories or as high a share of factories overseas as some of these other companies. I would really hesitate to target one specific company because I think in today's day and age, we have to be aware that the president is going to target the companies that he chooses to target. And I'm not sure that we have a playbook for why or how or what he will target. But what I will say is across industries, you've got something like 65% of industries in the S&P 500 with profound levels of factory exposure outside of the United States. It spans consumer staples to materials to industrials to technology. Big cap tech is just one of the stories. Broadly, technology is exposed to this as well. So it is going to be a potential long-term driver of volatility for the index.
All right, Gina, really interesting list. Great to get some time with you. That is Bloomberg, Gina Martin-Adams of Bloomberg Intelligence. Interesting, again, Apple's not on the Bloomberg Intelligence list, but we know it's on President Trump's list.
Yeah, absolutely. And that relationship, Tim Cook and Donald Trump, is going to be important for so many investors. Coming up in the next hour, Ilana Weinstein joins us on hedge fund talent wars. Plus, Elanco's Jeff Simmons talks about the pet care industry, more cat talk. And Acrisure CEO walks us through his company's billion-dollar deal with Heartland Payroll Solutions. We are 30 minutes into the trading day, and markets are flat. But we did see a spike at the beginning of trading.
We did. We are losing that spike. We're above 5,900, as you're reminding me, but we are seeing a bond market sell off just a little bit. Once again, some of the bears are back, I think, today.
Yeah, I've been watching for that because of the poor Japanese auction. I thought maybe we'd see the long end of the U.S. shoot higher again, but we're not over 5% on the 30-year, and I think that's the warning sign.
Maybe NVIDIA could change everything, and NVIDIA does have the final say today. The world's most valuable chip maker wraps up what has been a strong earnings season for big tech.
And billionaire Ken Griffin keeps cashing in. Citadel Securities posted record profit and trading revenue in the first 3 months of the year.
Making money. Plus some news that may make some hedge funds happy. President Trump explicitly guarantees Fannie and Freddie as he pursues a public offering for the mortgage giants.
But as you point out, Sonali, the spotlight is on NVIDIA. The chip maker will provide investors with a sense of if the flood of AI spending is sustainable. Joining us now is Bloomberg Equities reporter Ryan Vlastelica. So Ryan, set us up with the expectations. What does the market have to see to go to bed happy tonight?
Well, good morning. Thanks for having me. So I'd say this quarter is somewhat de-risked since we got pretty strong CapEx numbers from all the major NVIDIA customers, including Microsoft and Alphabet and Amazon and Meta. I think the real focus this quarter is going to be on margins. And if we see any further deterioration on margins, even though they remain pretty high for the industry, that's going to be a cause for some concern. The stock is up about 45% since the April low that came out for the first tariff announcement. That indicates a pretty high level of expectation going into this report. So any signs of weakness could be a cause for further profit, or at least some profit taking in the stock. However, I'd say analysts in general remain pretty optimistic about the company's prospects. We had the recently announced deals from the Middle East. All that points to just ongoing demand for AI-related infrastructure, ongoing growth. I'd say the setup there is pretty positive. The only question is, where do margins come in and how high are expectations given the stock strength coming into this report?
It's interesting. You're looking at NVIDIA trade at a price to earnings ratio of 45, nearly 46. On one hand, you could say that looks expensive, but very much not compared to where it was last year and even the year before. Now, if there is worry about margin pressure here, you've had NVIDIA flat to lower all year in terms of stock performance. Are investors basically telling you now, Ryan, that it's fairly valued? This is kind of as good as it gets?
Well, I think if you're looking at estimated earnings, the multiple is even lower than that. I think it is below its 5-year average. The growth outlook, at least at the moment, remains pretty strong right now. So if you're looking at something like the PEG ratio, it's one of the cheapest stocks of the Mag 7 by that ratio. So I do think people see value here. They do see an opportunity here. The growth outlook, at least for the next 12 months or so, it is still seen as pretty strong and intact. As far as where it goes from here, like I said, the stock is up 45% off of that April low. That's a pretty strong gain, even if it is more or less flat on the year.
All right, Ryan, thanks very much. Bloomberg's Ryan Vlastelica talking to us about NVIDIA. You can look at the forward PE estimates on if you type GE, and right now it's about 31, and you don't have that big spike from last year.
I had fund managers telling me how much they loved your chart yesterday after you showed it, so I figured we'd show it a few more times again.
Ah, shucks. Thank you so much, Sonali. By the way, we're going to show that chart probably tonight in our Bloomberg Technology Special featuring an interview with the godfather of AI, Jensen Huang, joins us at 6:30 p.m. New York time.
And joining us now, we're going to bring in Carin, head of portfolio management and equities at Fiduciary Trust International, which is a Franklin Templeton company. Now, you're looking at the market. We've had some of those gains come back. We are above that 5,900 level once again on the S&P 500. How do you feel? Do you feel like you can dip in a much bigger way, particularly if NVIDIA is to outperform?
Yes, so I think actually it's a tough environment right now because we've seen the markets recover to such an extent, and valuations are now back again at around 22 times earnings. So it's harder to, I would say, to be a buyer at these levels. I think you really have to be very selective if you're going into the market at this point. I think we've been fortunate to have sort of come into the beginning of trade negotiations with a very sort of resilient economy. And so first quarter earnings, as you mentioned, were actually quite strong. And we're not yet seeing really the impact of tariffs. And that definitely was not in the numbers in the first quarter. And in fact, we probably saw some front running that's baked into first quarter earnings. And so not surprisingly, we have not seen companies really guide down numbers. I think it was really, really surprising and remarkable that only about 3% of companies actually withdrew guidance due to the tariff uncertainty. And
we thought it would be every company, right? I mean, we were all in alarm, and we thought this is going to bring massive inflation, and everyone's going to pull guidance, and potentially the sky will fall. But it doesn't seem to have happened thus far, and it looks like now that some companies are really eating these tariffs into their margins. Does that continue through the end of the year?
Yeah, so we've heard from companies talk about the concern about a recession. In fact, I think about 25% of companies actually mentioned recession in their earnings call or in their guidance. But they're also talking about efforts that they're doing to mitigate some of the tariffs, either by some price increases or by shifting production and perhaps looking for ways to increase productivity. So we're not seeing as much deterioration in terms of margins in their guidance. But we'll have to see. I mean, I think that it takes some time for these tariffs to really play out. And they're still ongoing, right, in terms of negotiations. We don't know, actually, where they're going to end up. I think we've come a long way since what was first presented on Liberation Day. And it's been a continuous sort of, delays here. And we have some, adjustments or pullbacks, peelbacks in terms of the tariffs that have been announced. So it's still evolving, but we still have
assume 10%
baseline.
is the baseline?
Yes, I was going to say, yes, we still have a baseline of 10% that companies are dealing with. And, at some point, it may start to affect consumer spending habits. We haven't seen that yet, but, we may. I think we do, think that things will continue to slow down.
Companies are saying it's coming. Macy's just this morning said that they're selectively increasing prices due to tariffs. They will take a hit on their gross margin from 20 to 40 basis points. Now, you're seeing companies start to guide in that direction. What bothers me more, actually, is where we see long end rates, because that means mortgage rates will remain high. A lot of consumer finance goods will, or financing for goods will remain high.
Long-end rates, they're not that high, are they? I mean, we're not at 5% on the 30-year. We're not at 4.50 on the 10-year. It's just not happening.
Fair enough. We have been flirting with those levels, and we have 5% on the 30-year rather, and we've been kind of push-pulling. At what point does it matter? Mm-hmm. At what point does this have a bigger ripple effect?
Yes. So we've seen in the last couple of years that it appears as though about 5% on the 10-year was sort of a threshold in which the markets start to worry. It's also a threshold in which the narrative becomes, a concern about what's happening to banks' balance sheets, what's happening to the unrealized losses that they're carrying on their books, and also how is that going to affect, consumer borrowing and credit availability. I think that seems to be the mark that the markets are concerned about. So if we start to see that creep up, I think that might change the momentum in the market, because I do think that this is a very momentum-driven market. Yeah. I also think that mortgage rates are important, and I think that it's important for the housing market, and we've seen that creep up. That's where I think, the real impact of rates will be felt in terms of the economy.
Of course, yeah.
We'll talk about that a lot more later this hour when we talk about Fannie and Freddie as well.
Carin, great to have you on the set. Thanks so much for joining us. Carin Pay there of Fiduciary Trust International. It is a Franklin Templeton company. Sonali, I'm right there with you, worried about these rates, but they're just not going there.
You're right. 4.5, we've been living there.
Right, we're not even at 4.5 on the 10-year. We're not at 5. Every morning I wake up. This morning I said, a bad Japanese auction. We're going to soar over 5% on the 30-year, and it didn't happen.
Well, maybe if this is as bad as it gets, it's not so bad.
Coming up, we'll size up the state of Wall Street's competition for talent. Hedge fund headhunter Ilana Weinstein joins us next in the Wall Street Beat. This is Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Honeywell agreed to give Elliott Investment Management a seat at the boardroom table as it prepares to split into three. Elliott revealed a $5 billion stake last year and called for a breakup, blaming Honeywell's conglomerate structure for poor financial results and share performance. Meanwhile, UBS will sell its hedge fund unit, O'Connor, to Cantor Fitzgerald. The move will end a more than three-decade run of ownership by the Swiss bank. UBS is trying to minimize its riskier businesses as it faces extra capital requirements and tougher regulations in Switzerland. The transaction is expected to close in the fourth quarter. Bloomberg first reported on the sale earlier this month. And Citadel Securities posted record profit and trading revenue for the first quarter of the year. The firm's trading volume has been benefiting from increased volatility in response to Trump's trade policies. Sonali, they are knocking the cover off the ball.
They sure are, and it's posing much bigger competition to the banks. We're going to get more on that story in today's Wall Street Beat. Joining us now, Bloomberg finance reporter Catherine Doherty. Now, on one hand, this is a windfall, of course, for Ken Griffin that founded this market-making firm. But on the other hand, too, you look at net income surging 70% here. I was struck by that number because Citadel Securities talks all the time about how they can do it more efficiently. Is this the proof in the pudding, the numbers?
Yeah. I think the numbers that you're seeing out of the large market-making firms, it's all about technology. Sure, they have the people that are helping develop that technology, but they're doing it with fewer people. So their margins, if you look at and you dig right into this profit number, it is quite impressive when you're comparing it to the big Wall Street banks that are also having to deal with more regulatory scrutiny. So when you add up all of those things, and when you think about a bank having to develop their own technology, that's going to be a cumbersome process. It's going to take more time, and it might cost more for them because at the end of the day, they have a lot more checks and balances along the way. Not to say that these market-making firms aren't checking as they're developing their own tech, but they're able to move at a more efficient, faster pace.
It's all the more incredible because, and correct me if I'm wrong here, revenue was up 45%, right? And then profits up 70%. So they're squeezing more juice out of that lemon. And this is a company that's famous for paying such big salaries. I mean, they pay interns like $60,000 for a summer.
There's a lot of big figures here to look at, and Jane Street making $7.2 billion. That is what they were projecting to their debt investors for the first 3 months of the year. And this is even before you had Liberation Day in April. So these numbers that we're looking at and what Citadel's talking about in terms of their 45% jump in the first 3 months of the year, we are likely to see even bigger numbers for the second quarter. And this is following a 2024 that was record revenue and profit for these firms. And the banks, this is not to say that the market makers are setting records, that the banks are not seeing the same benefits. The banks, too, are seeing their trading. It's all on the back of huge volumes that have only continued in 2025. So we're likely to see that in 2025 full year numbers in the second quarter. Now, the big question becomes, when does that liquidity start to dry up? The market makers will be impacted by that if trading starts to pull back and folks are losing money and not just getting in and out of various trades.
But for now, a heyday. Remember, Jane Street last year, according to your reporting, brought in more than Citigroup and Bank of America. So this is becoming hot competition. Catherine, we enjoy your reporting. That is Bloomberg's Catherine Doherty. And now we're going to shift. We're going to talk about hedge funds. We're going to bring in Ilana Weinstein, IDW Group CEO and Founder, because for all the love the market makers are getting, the hedge funds don't seem to be feeling as much love. What are we seeing from the multi-strats in terms of performance after we seemingly saw a little bit of a rebound coming into May? Are they still feeling it?
Okay, so what's beautiful about the multi-strats is they're not as tethered. They are not tethered, I should say, to the market in terms of whether the market is up or bound or rebounding. That's for another category, which we'll get to. They are exceptional at managing volatility and putting up consistent performance. And what I would shine a light on right now, Sonali, is we have lived through one of the most volatile periods in recent memory, as we know, over the last several months. And the fact that the multi-managers have navigated this as effectively as they have, they've stayed in largely positive territory during the duration of this period, I think shines a light on the fact that the best ones, I'll say it like this, have moneyballed the industry.
Fascinating. So if you look at their ability to draw in talent, how does it compare to the rest? Because you are seeing, I mean, there's no other way to put it, crazy pay packages. You've been seeing teams lifted out for $100 million. You're looking at Ken Griffin trying to put a 4-year non-compete on in Florida. I mean, what does that talent war look like for the multistrats?
Okay, so, and that is, the multistrats are the biggest acquisitors of talent, right? By virtue of their name, multi-managers is really the euphemism that I'm referring to. They need multiple managers to manage capital. First off, let me provide some perspective on these pay packages. It's not like someone is getting an $100 million check and walking across the street and able to cash that. Okay, part of it is a hefty guarantee, for sure, to pay that person for the period they're sitting out. Part of it is deferred. Part of it is a wallet so that they can hire a crackerjack team. And a lot of it also is on the come, where they're getting, if you normally get a 20% payout, Sonali, I'm going to give you a 30% payout up to $200 million. That's an extra $20 million, but you got to make that $200 million. The bottom line of all of this is you don't want to be beholden to what I'll call the auction. So if you're a multi-manager and you lose someone, which you inevitably will, because this is a merry-go-round, someone leaves Peter to go to Paul, or you know what? There's a lot of capacity for this strategy right now. Let me take a crack at starting my own fund. How are you going to replace that person? Do you always want to be in a bidding war? No, because then you're beholden to paying, I would actually say maybe overpaying for air quotes talent. These people are not necessarily as talented, or remains to be seen, as the headline numbers would suggest. That's a lot of money for the multi-managers to have to recoup on their investment, TBD on whether they will. Much smarter to grow talent in-house. And the best ones, like Point72 and Citadel, are a factory for what I like to call alpha makers.
That's what I was actually going to ask about. So I don't obviously know as much about this industry as Sonali, but it would seem to me that a lot of these people learn on the job. So can you foster a sense of loyalty? Does Steve Cohen do that? Does Ken Griffin do that? When you build them up from the bottom up, it doesn't help, obviously, IDW if they, make these.
Well, it does help IDW, because the reality is, if there is a culture, and that's very hard, they're not all created equal in terms of their ability to train and develop and mentor and make you, Matt, the best version of yourself that you can be at each point along the experience curve, and also give you a pathway. It's not just about coming in as an analyst and being a good analyst, or coming in as a PM and being a good PM. At Citadel, you can go very successfully, as at Point72, from analyst to PM to running a business. How exciting is that? You could be a business head at Citadel. Steve just created a new fund around one of his PMs, Turion, right? So that's a pathway where now you have, in that example, Point72 with you to raise capital. They raised $1.5 billion out of the gate, and the PM has all of the incredible resources available to him at Point72. That's not all multi-managers created equal, and that's what creates stickiness and durability.
And then the ability to build out a team under that, perhaps. One question I have is where we're not seeing as much success. It looks like the long-short business this year, for all of the volatility in the market, has not played out quite as well, and that comes after some really tough years in recent years.
Yes, so well said.
What's going on?
Okay, so you'll see the returns in May. Breaking news, really not. They're going to be better than they were in April. So is the market. The problem with this is, one, the swings of volatility. Okay, I'm not going to name names, but there are so many examples of funds that were down in the mid-teens in April, and now we're up mid-single digits. Think about that as an LP, and think of how nervous that might make you about what's going to happen next month. And as an LP, what I'm thinking about is, how much alpha am I getting net of fees relative to the underlying beta exposure? That's very complicated. I don't want to think about that. I want alpha, and I have the multi-managers in order to access that, or I want beta, and I can pay nothing for that, right? Buying an ETF or the S&P. Where the long-short funds will raise money is not in their hedge fund product. You heard it here first, Sonali. They are not raising capital. I don't care what they tell you in their hedge fund product. Where they are raising capital is long only, because there is appetite for the alpha component of a beta product.
Can I just ask quickly, I have a curveball question for you.
All right, let's hear it.
Traditionally, Harvard has been a feeder university for these masters of the universe, right? Do you see that continuing after this kerfuffle?
Well, my son goes to Harvard, so I don't know how I'm supposed to answer that question. Yes,
you went to Harvard, right?
I
But
did.
who else can provide the best financial minds in the world?
Well, I mean, there's a lot of good schools out there. I wouldn't say Harvard has a lock on that. What I will tell you is it pertains to talent, and I've seen this up close. Literally, I visited my son a few weeks before the end of the year, and I was hanging out with him and his friends who are finishing their sophomore year, Matt. And the aggressiveness by the top hedge funds, namely the multi-managers, in locking up these kids
sophomore year.
For their junior summer. And the pay packages, so the talent war has gone way downstream, as we've seen, and you guys alluded to it as well earlier, are huge, even for kids, so that they have first dibs.
Ilana, we got to leave it there. Wish we had more time. That is Ilana Weinstein of the IDW Group.
We'll have her back, because we have to continue that conversation, right?
This is Open Interest. Stick with us.
Animal healthcare company Elanco making a pair of announcements this morning, reaffirming its second quarter guidance as well as full year, also announcing a new CFO as the company looks to accelerate growth and take on, let's say, the Goliath of pet parasiticides. For more, we're joined by Jeff Simmons, Elanco's CEO. Elanco produces medicines and vaccinations for pets and livestock. And Jeff, great to have you on the program.
Great to be here.
I want to talk about the things that Harvey takes to fight off worms. That's Sonali's dog. Until now, you've had a much bigger rival in the market, but you're starting to gain market share, right? I think about 10%, if I'm not too far off.
That's right.
How important is this market to you, and how are you going to make some headway there?
Yeah, great question, Matt. Great to be here. Yeah, so the tick, flea, worm market's about a $6 billion market globally, growing rapidly, and these broad spectrum oral products are the fastest growing segment. We have just launched Credelio Quattro, first FDA product approved with actually 4 active ingredients, so we've got broad coverage with this product, the product's off to a really good start in the fastest growing market. We think it's best medicine, and we're leaning in. We're spending a lot of money right now on a very big launch. And, we were talking before we got started, just the willingness to spend and take care of that pet. We've never seen stronger data, and that's what's making this market so resilient in these volatile times.
I'm laughing because my dog's name is Loki.
I'm sorry, because Kriti Gupta, a friend of ours, she also has a tiny little dog, and it's named Harvey.
But he eats this food called Dr. Harvey's, which is like a natural pet food, and that is my question to you, because this is, at the risk of sounding like crazy dog lady, I fed my dog salmon at least once or twice a month. It's gotten very expensive to do that. When you think about people who are taking care of their pets, how much are they choosing between their budget right now versus their pet's health?
It's a great question, and what I would say is, as we're looking at the information, you got to have a portfolio of products that adds value. There is brand loyalty in this industry as well. So as we just mentioned with a Credelio Quattro or any of our products, but the willingness to spend continues to grow. And believe it or not, the kind of Gen Z and alphas and under 30, the willingness to spend is even greater than their generation, their parents' generation. So I think it's important, though. We've gone on and we've made some acquisitions of Bayer Animal Health. We've got OTC inside the vet clinic and outside the vet clinic. Large customer Elanco is of Chewy and Amazon. Making customers be able to get their innovations more conveniently is really key, and Elanco's a leader in that space.
Dare I ask, you recently sold a business to BlackStone, but you were able to use that to pay down debt, right? What is your inclination to do more M&A?
Yeah, I would say our number one priority and what we did with that is it was a really pretty neat deal, and one of the first ever is we took an animal health asset and moved it in to human health, and we monetize the royalties off from that. Our focus right now is free cash flow conversion continues to grow in Elanco is to actually pay down debt. We are right now on a continuum of accelerated value creation by accelerating growth rates. We're globalizing the biggest innovation year we ever had last year by taking these products globally. We got a company-wide margin expansion, and then we're really working on strengthening that balance sheet by delevering. So M&A will be targeted by R&D, but the big focus will be bringing down debt and increasing free cash flow.
How important is the pet market? How important are Loki and Harvey compared to livestock and horses?
Yeah, Elanco has been very intentional the last 5 years, organically and inorganically, to build. We are about 55% outside the U.S., 50% in, 45% in, and then the same on kind of the pet side, about 55% pet, 45% livestock. I think what makes this industry so durable right now, and Elanco a compelling value proposition within it, is a diverse business. It is durable, and it has two tailwinds: pets, the humanization and globalization of pets, and protein. I mean, as you look at animal protein, meat, milk, eggs, fish, that demand, as people are looking at better nutrition, we had historical animal protein consumption last year.
Since you have such a large business outside of the U.S., how are tariffs impacting the discussion you have with your international clients?
It is something we're in constant dialogue. We're a value-based company. We're all about making farmers more money globally, as vet clinics and pet owners as well. I think we took a very prudent and proactive approach at earnings a couple weeks ago by saying, hey, the current global tariff situation and all scenarios we see going forward, we encompassed inside our guidance, which we reiterated again today. We see accelerating growth and margins in that guidance. So I think investors appreciated that. But I think a global business, we're pretty balanced overall. Still, the majority of innovation and the majority of manufacturing is still based here in the U.S.
Our Bloomberg intelligence analyst, Ann Hunter Van Kirk, gave us some intel on this sort of parasiticide market. And I think it's interesting that Zoetis has Simparica Trio, and you have Credelio Quattro. And I was wondering, why not just go straight to Cinco? Did you not think about that?
Our pipeline's full of innovation coming, all right? We're going to have a consistent flow of innovation.
What's with the numbers there? Is that like the amount of things it can kill, or?
Yeah, it is coverage overall. And, there's differences between, but we've got 4 active ingredients. Again, we've got broad coverage, tick, flea, as well as that broad coverage of numerous worms. And what do ultimately pet owners want? They want, hey, we want coverage, we want convenience, we want it delivered, we want to assure that it's something I don't need to think about. And
edibility. You got to be able to convince the dog to eat those things, right?
You do. And I think we're seeing some great receptivity back to the 10% quick taking of share of this market early into the vet clinics is the palatability really matters. And we're seeing that as another, we believe, differentiation.
So that's the trick.
Is that what helps with
everybody has their tricks.
Exactly.
Jeff, thank you so much for joining us. Fascinating business. Jeff Simmons there of Elanco. Let's get a quick check on what's going on in the markets right now. It's been a bit of a drift after an initial spike. We're obviously waiting for NVIDIA results, but the S&P is now down almost 0.2%, still above 5,900 at 5,912. So we're holding above that level.
We did lose the gains of the morning. We firmly lost the gains.
Instantly lost those gains. But yesterday we were up 2%. So you can see the NASDAQ, really little change there as well. It's all about NVIDIA, but we had a bunch of retail earnings.
Yeah, Macy's turning around. That's pretty interesting. I'll look at some stocks moving under the hood. It's been a really interesting trade for the consumer. Abercrombie & Fitch has been soaring after the retailer posted first quarter results that topped estimates. Macy's now climbing after results show that the department store's new strategy is starting to pay off. That's even as they say they will pass some prices off to the consumer, Matt. Okta falling. This has been an interesting company. This cybersecurity company gave a weaker than expected outlook. We're continuing that earnings mixed bag. We're also continuing a story about M&A because insurance broker Acrisure makes a new $1 billion acquisition to expand its fintech services. This has been a big market for deals this year. We're going to speak with Acrisure CEO Greg Williams next. This is Bloomberg Open Interest. M&A Tuesday and an M&A Wednesday. Acrisure is buying Heartland Payroll Solutions for $1.1 billion from Global Payments. Global Payments has been deal-making a lot this year as well, you might have noticed. But the insurance broker is hoping to expand its fintech services to become a one-stop shop for customers. Joining us now, Greg Williams, Acrisure co-founder, chairman, and CEO. It's been an interesting run for you, Greg, because, of course, you raised money at a well over $30 billion valuation pretty recently. You used some of that money to buy this global payments unit in cash. What does it say about what you want to become as a company?
Well, I think this journey, Sonali, this journey started for us really 5 years ago when you start thinking about we made a $400 million investment in an AI platform in 2020, and that gave us the data insights and the information about a marketplace that we didn't have at the time, that we've been building over the last 5 years. And now you think it and look at what we have. We have 200 billion data elements of information about a marketplace. We have 6.3% of every business in America is an Acrisure client, as we see here today. 97% of those business clients have 100 employees and less. And so, they have lots of, I'll call them non-discretionary needs as it relates to insurance and other financial products and services. And so this transaction really is just going where our clients want us to go, in the sense that if you poll the marketplace, and we do a lot of surveying, and you ask them, would you like to get all these financial products and services that insurance and cybersecurity, payroll, payment processing, wealth management, et cetera, the list goes on and on. Would you like to get them from a dozen different parties, or would you actually prefer to get them from one? And increasingly, the clients, 89% of them will say, we'd like to get them from one. So really just stepping into the gap and stepping into the breach and responding to the client's needs and doing that with, again, an AI platform that just gives us deep insights, predictive modeling about who's likely to buy what. And this acquisition really fills that product need for us.
Greg, what's interesting to me, and by the way, I think you're speaking to a lot of big trends. Small businesses want to save costs, so they are consolidating a number of vendors they go to. It's probably one of the bigger reasons you're seeing M&A in the fintech space so largely. But when I spoke to you about this deal, I also asked you about your potential for an IPO, and this is what you said to me, that you are considering spending time and money to be prepared under the right possible conditions. Now I ask you, what are the good conditions for you to go public? Is that something that is in your near future?
Well, certainly, as I like to describe it, look, we've got to preserve optionality. The size of the business today, it was 12 years ago, this was a $38 million revenue business. Fast forward 12 years, it's over $5 billion. And so it's a 48% compounded growth rate over a dozen years. The size and scale of the business today, the number of stakeholders that we have, really, I think, if you just, again, size and scale alone kind of sets you up to where you kind of know what your destiny is going to be. And so we've worked diligently to be ready. That's still a work in progress for us, so it's not any declaration that we're ready to go. It's still very much a work in progress. I think that is our likely destination at some point in time. And so, A, the company's got to be ready, first and foremost. And B, market conditions, have to be right. And as we're getting ready, we're obviously closely monitoring markets to determine what's the right time.
I wonder about what you're hearing, Greg, from small businesses, from your clients about this economic environment, because as we've been saying today, there was a lot of people absolutely losing their minds over tariffs, and now obviously over this new one big beautiful bill. But it's not coming out so negative in the hard data, and it looks like consumers are still hanging on. Like, what intel are you gathering from the CEOs that you talk to every day?
Well, it's interesting when you look at our marketplace. Again, 6.3% of every business in America is an Acrisure client. So we have daily interaction with the marketplace, and I would tell you, Matt, the sentiment is not as negative, at least in our world with our client base. The sentiment is not as negative as you might expect. The volatility is not quite what you might expect. It's more bullish than bearish by far in terms of their outlook for what's going on in their world and their respective companies, and so we've continued to lean in that. Again, stay very close to market sentiment, but what we're seeing in primarily this SMB marketplace, as it referenced in terms of the size of our clients, predominantly the size of our clients. It's it's pretty bullish and high degrees of confidence going forward.
But, I want to pull up the Russell 2000 just year to date as a barometer of how investors have been feeling about small and medium-sized businesses. It's still down almost 7% on the year. We don't have the most recent NFIB reading of small business optimism, but through April, it deteriorated for 4 straight months. And when you have that kind of sentiment hanging around the hoop, how is it changing business decisions from small and medium-sized businesses that have been the lifeblood of the American economy?
Well, I think, Sonali, that is the kind of the key is that, what we've done is we focused on, I'll call them non-discretionary products. And so insurance, payroll, payment, cybersecurity, and the likes. And so it really is not, it's not an existential, or it is an existential issue, is that if you're in business, you're going to buy those products and services. It's at what scale or what spend are you allocating to those things? But they are non-discretionary products, and maybe perhaps that's why we're seeing more optimism than maybe the market and the broader market seeing. Is that at the end of the day, we are dealing with them in a non-discretionary product environment. So I think that's probably why we're seeing it, what we're seeing. But those would be the things I would cite most notably.
Greg, great to have you on. Really good intel to get from you. I appreciate it. Greg Williams there talking to us from Acrisure. Coming up, President Trump says the U.S. government would retain guarantees on Fannie and Freddie even when they become public firms. And he was explicit about it. This is Bloomberg Open Interest. Shares in Fannie and Freddie rising today. That's after President Trump posted about the mortgage lenders on Truth Social yesterday. Donald Trump saying the U.S. government would retain guarantees on Fannie Mae and Freddie Mac even when they become public firms, which he's working on. For more, Bloomberg intelligence analyst Ben Elliott joins us now from Washington. He covers mortgage lenders. Ben, it's interesting to say that the shares are rising and then talk about them becoming public firms. What is the state of Fannie and Freddie right now?
Yeah, so look, definitely the hardest part of getting these companies out of conservatorship is convincing agency MBS investors that there's still no credit risk involved when they buy securities issued by Fannie Mae and Freddie Mac. So hearing the president say that they definitely intend to have the government still have a role is obviously very positive. And you've seen that in the price action today in the commons and the junior preferreds. But I think sort of another interesting way to look at this, right, is if you look at how agency spreads have reacted today and during the president's prior tweet, they didn't really move that much, right? So the actual bond investors here are just assuming that the status quo is going to be maintained even before the president tweeted what he did last evening.
So you have the president, maybe even the Treasury Secretary. They're talking about him a lot in this regard. You have the FHFA director that is preparing Fannie and Freddie for a potential for public entrance. What would lawmakers say? Because realistically, the big fear about releasing Fannie and Freddie into public markets in this way is mortgage rates and whether they will be untethered. What do you think?
Yeah, so lawmakers have perpetually been unable to come to sort of any kind of agreement on this issue. They've had 15 years plus to do something about it. At this point, I think the administration feels they have quite a bit of political cover to just go ahead and do what any administration was able to do unilaterally. But I think if the president didn't have as much support as he currently does in Congress, that they would be a little more trepidatious about sort of getting out over their skis on this.
Can you just explain, though, Ben, what it means to go public? Since I can already buy and sell their shares in the public markets, it's a little bit confusing to a lot of people.
Yeah, so what's interesting, right, is if you look at HDS in the Bloomberg terminal, you're not going to see everyone who's a holder of the common stock disclosed there. And that's because a lot of funds have decided that since the shares don't have any sort of voting right, there's really no economical ownership implied from owning the commons, that they don't have to disclose their stakes in the common shares. And that's because the government stake is so overwhelming that it would basically dilute sort of any value that the commons currently have.
I'm just going to ask the unpopular question here. And say, you have a lot of hedge funds, very prominent hedge fund managers. Many of them are large backers of Trump that are
Bill Ackman,
John Paulson has been a historical owner. They have been looking to see a privatization for a long time, since the last Trump administration. But does it come at the expense of Main Street? Ultimately, the big question is, does this make borrowing costs higher for Americans looking to buy homes? Can you be convinced that it won't?
Look, the status quo has worked very, very well for at least a decade. So anything they do here really is likely to rock the boat. There's no reason to assume that borrowing costs, for instance, would go down as a result of privatization. So even if they stayed the same, that would be sort of the best outcome for the administration.
Ben, we thank you so much for your time. That is Ben Elliott from Bloomberg Intelligence. And it's interesting because I want to actually show you what FICO is doing year to date. It's down almost 20%. It's snapping back today on a Baird upgrade. But remember, the reason it has been falling in part is because you have the FHFA director saying that credit score cost decisions are coming in weeks. They are not happy with FICO. You have an administration member very, very directly blaming FICO here on putting the pressure on consumers when it comes to their ability to borrow. And FICO, remember, has been a kind of a thorn in a lot of lenders' side. It is kind of the only game in town, as you know. So it's fun stock to watch these days.
Anyone who's dealt with it has been, I'm sure, frustrated with it. So it's understandable that a populist government would have issues with, I mean, that's a way to win points straight away, is attacking FICO. I'm just marveling at Fannie Mae. I mean, we talk about going public and how will public markets react, but you can buy and sell these shares on a regular basis, and they are up 664% in the past 12 months.
It has been an enormously popular hedge fund trade, I've got to say, and a retail trade these days, too.
All right, let's get a check on what's going on in these markets other than mortgage lenders and credit score agencies. We're looking at red arrows, and it's interesting because futures were so flat. We did then have a spike up into the green in the first few minutes of trading, but the S&P 500 is now down 0.25%. Still over 5,900, but near as damn it to it. And the NASDAQ is also falling, only 0.1%. But it's NVIDIA that we're also focused on, right? And you can see those NVIDIA shares down about 0.2% right now at $135. Those earnings coming out after the bell, and that is obviously going to be the main focus of the day.
Absolutely. But you do have, to your point, not only a reversal of the S&P, almost every sector is in the red right now, every major sector. So really a reversal of breath going into that NVIDIA print. The other question, Matt, will NVIDIA save the rest of the Mag 7? There are doubts behind that.
All right, coming up tomorrow, Sonali is live from the Goldman Sachs Leveraged Finance Conference in California, speaking with the company's vice chairman, Robert Kaplan, the head of global credit, Christina Minis, as well as the MoneyGram CEO. And that's a lot. We're looking forward to it.
Thank you. We'll see you then. This is Bloomberg Open Interest.